on, it is time to hear from our very own impact investors in the industry on their views on how different sector dynamics have played out in the last year. I am pleased to invite Ms. Anuradha Bajaj, co-founder at Baytree, as a moderator for the discussion. Baytree is an online marketplace for socially motivated entrepreneurs and investors. Anuradha Bajaj heads up Baytree and comes with a background in commercial banking and international development, and has previously led financial sector development, including impact investment at Department for International Development, UK government. Joining her on the panel, we have Akshay Panth, Director at Neev Funds, Amol Warange, Director, Investments at Omidyar Network India, Namita Dalmia, Partner at Enzia Ventures, Shiva Shanker, Vice President, Investments at Ankur Capital, and Srinivas Ramanujam, CEO at Villgro. Over to you, Anuradha.
Great. Thank you, Dipanji. At the outset, I'd like to congratulate the entire IIC team for this really fantastic report and its insights. As we all know, data is critical to all of us asking the right questions. And unless we ask the right questions, we never find solutions to the problems we're trying to solve. So great job done, Ramraj and team. I'm not going to summarize any aspects of the report as you've all done it brilliantly just now, but just noting that in 2021, we saw $6.8 billion of investment flowing into the impact investing sector in India. This is a fantastic achievement and it must be applauded. However, I do note that most of this growth was pushed forth by a handful of deals which were absorbing very large amounts of capital. In particular, 14 companies cornered about 60% of the total financing. So noting that, the other important thing from my perspective that I noted was that 1 out of every 5 enterprises that raised capital in the last 3 years has been founded by a woman. Again, while this is fantastic news, I do note that that number has remained steady and not increased in the last 3 years with all our focus on gender lens investing. So I would like to focus our discussion today to review the great year we've had, yes, but to also identify the challenges ahead. In particular, I'd invite our panelists today to reflect on what more needs to be done on 2 specific areas. How do we seek, foster, and grow more early stage innovation to address our social and environmental challenges? So greater focus on early stage. And second, how are each of you thinking about gender lens investing in your respective approaches to seeking and funding new ideas? I'm delighted to introduce our very experienced panel for this evening, who will help us answer some of these questions, I hope. Please join me in welcoming Akshay Panth, who's the Director of Investments at Neev Fund. He's going to today cover climate tech. We have Amol Warange from Omidyar, also Director of Investments, covering financial inclusion and fintech. Namita Dalmia, founder and partner at Enzia Ventures, covering education. Shiva Shanker, VP Investments at Ankur Capital, and you're covering agriculture, Shiv. And Srinivas Ramanujam, CEO at Villgro. Hi, Srini, you're covering health for us today. So I propose we each of you spend about 10 minutes on your assigned topic, 5 minutes sort of covering with your remarks, and then we can have 5 minutes of discussion. And then hopefully we'll have time at the end of the session to get some audience Q&A in. Does that sound okay, everyone? Okay, great. So Akshay, we'll start with you and climate tech. It's been a very, very attractive and buzzing sector this past year. In fact, it's the only sector to see a higher number of deals in the early stage. So what has really driven this growth, and what are your thoughts on the year gone by?
Thanks so much, Anuradha, and thank you, IIC, for inviting us to the panel discussion today. Anuradha, to answer your question, firstly, I guess climate change is reality, and nobody can sort of wish away that, or nobody can look the other way in terms of the need or the requirement to address climate change. What we've seen historically is that a lot of money has gone into the traditional sectors of addressing climate change, more in terms of mitigation strategies which deal with, say, energy itself, and emission control, which essentially means that energy and mobility are the two sectors which would have seen a lot of money going in climate tech. What we've seen of late over the past couple of years at least, and that's a trend which we're seeing increasingly, is that more and more money is going into more adaptation technologies, which is essentially technologies or solutions which deal with the impacts of climate change rather than the mitigants to or mitigation of the emission itself, right? So we're saying, okay, climate change is a given. There are certain adverse impacts. Now, how do we build technologies or products that help us cope or deal with these adverse impacts? Be it agriculture, be it sustainable infrastructure, be it disaster resilient infrastructure, be it different sectors. And that's a trend that we're seeing increasingly in new age businesses, which are coming up with innovative products and solutions to deal with more adaptation linked solutions. And that's where perhaps you've seen, and that perhaps correlates to a lot of seed or early stage money going in climate tech in the past 1 year, where we've seen new age businesses coming into this space. Yeah.
Great. So I think it might be worth then us delving a little bit more into that, perhaps as much for my benefit, but I hope also for the audience benefit, is, give us an example of a few of these deals particularly in adaptation. I would like you to cover if there is time, a little bit on what we are seeing with respect to agriculture and climate change, if anything as well, and regenerative agriculture and those kind of technologies.
So, for example, in agriculture, we're seeing soil productivity, right? Something like soil productivity. You have a certain, you have a given that climate change is impacting crop cycles and the way the crops, the harvest seasons and floods and the monsoon patterns. So given that's a reality, what are we doing now, therefore, to enhance crop productivity, enhance yield, right? And therefore, soil productivity solutions that come up, be it natural or sort of organic soil productivity solutions that come up, is an example that we're seeing a lot of businesses come into that space. So that leads to sustainable agriculture. We're seeing food wastage as a potential problem that arises. So how do we solve food wastage, right? Be it distributed, and Shiv will perhaps get into this in more detail when he deals with agriculture. Sorry, Shiv, just to sort of get into your overlap into your space. But what we're seeing is that distributed cold storage systems, right? That's something that is evolving fairly rapidly, and we're seeing solutions that take cold storage right down to the doorstep of the farmer, and therefore from there on to the mandi and subsequently to the storage itself. We've seen silos being developed by the government through the modern silo policy that the Food Corporation of India has, which reduces food grain wastage from the 30% that it currently is down to about practically nothing. So we're seeing a lot of these technologies and products come up, companies getting into these spaces, startups getting into these spaces, and building out successful businesses. So these are three examples, particularly in the agri-tech space, that I can think of.
Okay, great. And what about energy storage? Are you seeing much action there, particularly with connectivity to the grid and, talking about mobility sector, batteries, and the connection with the grid? Are you starting to see some traction
there? Yeah, absolutely. So what was earlier a sort of a linear model where there was a particular point of generation, a transmission into the grid, and then a user at a subsequent location. What is now evolving is a multi-distributed model where the consumer himself or herself is also sorry, a bit of a background noise. So the consumer herself or himself is also a generator, right? So you're seeing models evolve where it's not just a linear model, but a multi-directional model of energy flows and therefore payment realizations, right? So you're seeing a consumer who was earlier, let's take a residential distributed rooftop space, for example. Earlier, the residential association was deriving its power from the state grid or the city grid. Now, all of a sudden, there is a rooftop solar plant and in the residential facility which generates its own electricity, right? Now, how do you bill for that? There are different models of billing that evolve. Who owns the asset? Who does not own the asset? Does the RWA own the asset? Is it the developer who owns the asset? What is the credit worthiness of the RWA? All of those questions come into play. But we're seeing models where even in, say, energy, we're seeing a multi-directional flow, so to speak, of energy. No longer is it just a linear flow from a point of generation to a point of usage.
Thank you. So in terms of challenges for the year ahead, and particularly with reference to the two topics we delved a bit deeper on, are there any particular things you think we need to do more of as a country and on the policy framework? Is there more support that is needed, more clarity that is needed to help foster some of these innovations?
I think policy is the key thing, and sort of you hit the nail on the head when you said that should we do more on policy. Policy obviously is the key thing. It's always been that policy has been catching up to business models. I think that we're seeing it catch up sooner rather than later, and hopefully that's a trend that will go forward. Policy would keep in pace with newer and newer business models that evolve based on the market's requirements. And hopefully, yeah, policy for sure is something that has to come in place for each of these sectors, be it, say, in energy, distributed energy. There is a sort of open access policy that has come in certain locations, but that's still on a larger scale. It's not there for a smaller scale. So policy for distributed solar at a much smaller scale, policy for perhaps a cold storage, distributed cold storage network is something that can be looked at, but policy definitely is a requirement.
Okay, great. And then my final question to you for now, Akshay, is how are you approaching your portfolio with respect to gender lens investing? How do you particularly seek, foster, and fund women-oriented, not necessarily just women co-founded or women-founded, but women-oriented businesses?
So out of the portfolio that we currently have, Anuradha, in the Neev fund, which we've fully invested, we have a strong women-led representation. We have about 4 companies in which there are co-founders. Out of the 10 portfolio companies, 4 companies are either women-led or women-founded businesses. Besides that, we also have a very particular ESG requirement of gender reporting to our investors, gender diversity reporting to our investors, and we have specific targets on the diversity in terms of the workforce itself in the organization. So there is a parameter that we sort of keep tracking on a monthly basis, and we report to our investors on how the workforce is in terms of gender diversification as well.
That's fantastic. Really great to know that. I wonder if any of our panelists have any specific questions for Akshay before we move on. No? Okay, well, in that case, we'll move on to the next topic, but we'll probably circle back to you at the end, Akshay.
Thank you so much.
Thank you so much. Amol, welcome. And you're going to tell us a little bit more about how the year has been for financial inclusion. It is the leading sector in impact investing, and not least because it started with microfinance, the earliest version of impact investing, a good 3 or 4 decades ago. So we've had the benefit of that combined with the initial innovation and fintech. So how's this year been, after I recognized on the back of 2020, 2021 was much better. But from your perspective, what were the key highlights of the year?
Sure. Thanks, Anuradha, and great to be here on this panel. So like you mentioned, really a sector which is well understood now and discovered to a certain extent. So let me break that question into 2 parts. One is what's happening in the industry, and second, what have been the capital flows. Right. Now, as far as the industry is concerned, we came on the back of a very tough year, which was 2020. And since then, most of the businesses have picked up and gathered traction over the last year. Of course, there are nuances where certain segments have done better. And there have been new sectors which have also emerged and got popular during the last year, right? So just to break that down, on the credit front, which was the worst hit sector in 2020, there's been a good rebound both on the MSME side as well as on the consumer side. On the MSME side, you have new businesses or new avenues, for example, supply chain financing or embedded finance, which is picking up. On the consumer side, we have seen the new card companies emerging as challenger products to the age-old card industry. The second sector would be the general MSME digitization plus fintech theme, whether it be the kiranas or the small businesses, where the embedded finance thesis is playing out pretty well, and financial services have got embedded into the value chain of the business. Third, I would say health tech plus Insurance, again, given what we saw play out in the last 2 years, insurance plus managed healthcare models, especially primary care, seem to have got a lot of traction, both on the user as well as investor front. The last bit is decentralized finance. All of us know the headline numbers. We still have to see how the tech plays out, and how the crypto world or the DeFi world meets and solves real life use cases. And underlying the growth of all these sectors is the financial infrastructure play, API banking, general connectors which connect the consumer facing businesses to the product providers or the networks. So that's generally what has happened as far as the business front is concerned. On the capital side, again, financial services always has been a sector which has attracted significant capital flows. And this year has been no different, right? $1.5 to $1.8 billion. The numbers are there in the report. If you count the very early stage deals as well, seed and before that, probably 300 odd deals in the last year. So there are 2 points here which I would make, which we see in not just the financial services space, but generally in the early stage space in the last 12-15 months. One, there have been new sources of capital. So if you look at just the last year, around 440 odd new investors invested for the first time in India. A lot of them with an impact agenda or an ESG agenda. There's government which has stepped up its investment play. The second, I would say, is M&A. We have seen fintechs, as also other tech firms which have scaled up, now looking to acquire other companies. So an Asper's acquiring a LazyPay, a PaySense, or a Pine Labs and Razorpay making a lot of acquisitions. I mean, if you go back to the earlier days where a Flipkart Myntra was the deal which made headlines, today Byju's acquires probably one company every quarter. So really M&A activity has picked up quite significantly. The third would be capital markets. We have seen 2 fintech IPOs this year already. There's Policy Bazaar, there's Paytm. So new sources of capital, not just in fintech, but also in the other sectors. The second point would be rounds getting larger. I was just looking at our deal flow and the analysis we do internally. The number of deals have largely remained constant in 2021, but the capital gone in has gone up 3.5x, right? And I think there are reasons why this is happening. One, generally, the funds have got larger as LP allocations to venture as an asset class has got larger. Secondly, probably political reasons, whatever has happened in China probably moved some capital here. But broadly, this is what has been happening. And financial services capital is the raw material for many such businesses, right? So that has played out really well. So broadly, this is what has played out both on the business side as well as on the capital flow side.
Thank you. That was actually a fantastic summary, Amol. So what are you seeing as challenges for the year ahead?
So first, I would say key shortage of quality people, both on the, I mean, at all levels, especially on the tech side. Today, to get somebody on board, you probably need to make 3 offers, right? Especially on the tech side. So I think that is definitely a challenge. Second, I would say, if you look at the global cues, whatever is happening in the US markets, the valuation correction, generally, I think there will be capital consolidation. Not to say that there is no capital, but it will gravitate towards well-run companies, good founders, large end markets. Something linked to this, the companies that have gone and already raised huge sums of capital, 70 plus unicorns, a lot of it is on future growth prospects, how they will execute. So somewhere they will have to execute towards that, show some revenue streamlining or monetization potential, or the growth versus profitability is an endless debate. but at some point unit economics becomes important as capital consolidates towards promising businesses in the next 2 years. The last point I will make is focus on governance. We unfortunately see stories playing out, but that really is an important factor at all stages, early stage, late stage, wherever. So I would say these would be the things to watch out for in the next couple of years.
And may I ask, I mean, we talk about ESG as one thing very often in one breath, but there is the E, the S, and the G, and I'm sure all portfolio managers look at them very consciously. It'll be helpful to then, in the context of your last comment, tell us how are you sort of promoting good practice, shall I say, not just with gender lens, but also on governance, which is becoming increasingly important globally. So maybe in the same question, I'm wrapping up both gender and governance for you to cover, Amol.
Sure. So let me first address the gender part, where we have done some work over the past few years. So this is front and center at our investment philosophy at ONI, and in lines with what Akshay had mentioned, we also actively look out for such businesses. In our current portfolio of 65 plus companies, around 20% would have women founders, stroke CEOs. And all of us know there are compelling reasons to pursue this, right? Apart from the economic or the business case, there is a societal case for all of us to acknowledge and try to correct the historical asymmetries, right? So that's how we have designed our investment philosophy. And you had mentioned this, Anuradha, briefly. When you put that question to Akshay, it goes more than just the founders, and the management team. It can include customers. Are you solving or making products and services which specifically solve for women? It could involve supply chain. Can you ensure that your business keeps this in mind when it tries to build its own supply chain, and so on and so forth? So there is a CDC and IFC framework that we have looked up to, which is on gender smart investing, and which is what we try to follow when we do these investments. That's on the gender side. As far as
just dwell
yes,
on that a tiny bit, Amol. And the only reason
sure.
I'm sort of going to, I mean, Omidyar is a very thoughtful and experienced impact investor. So I'm sort of keen to push this a little further with you. So we've seen in the IIC report that the even if you take the simpler aspect, simple to measure aspect of gender lens investing, which is women founded enterprises, the number has remained static over the last 3 years. With all the global noise, reports, championship that's going on for this thing. So how do we push the envelope? How do we push this agenda? So you're saying you've got about 25 or 30% in your portfolio as well. How do we get it to 50?
Yeah, I mean, that's a question which we are also,
I don't mean to put you on the spot. I'm genuinely wondering if you're thinking about this internally, and what more can we do as a collective to push this agenda?
Sure. So I'll try to answer this by probably sharing what we have tried to do, and maybe that overlaps with others or it does not. So one, we picked up specific use cases or segments where we see women are underserved, and we have gone and sought entrepreneurs who are trying to solve this problem. So for example, MFI, as we know, historically started with women as borrowers, right? You extend the same thing to what about women as savers? We know they have a life journey where you can have saving goals which are tied to these life journeys, right? So can you structure products around them? And we as investors, can we encourage people who are looking to build this, either through entrepreneurship in residence programs or trying to provide them support till the time this becomes a commercially viable opportunity? So that's one example which I can give on what we are trying to do on this side. hopefully that answers your question, at least to a
Yes, it
certain
does.
extent.
Thank you very much. That was very helpful. Sorry to interrupt you. You wanted to mention governance briefly.
Yeah, sure. So on the governance bit, it's a bit tricky, right? A lot of it is really alignment with the founder and entrepreneur, right? It's not something that you can force on or you want to go in and change people, right? So I think the initial alignment and vision in terms of how do you want to build your enterprise is the key here. Beyond that, as investors, we do have our own ways to institutionalize it as much as we can. So there is a initial framework and a toolkit that we share with all our entrepreneurs in terms of best practices. We engage very actively in the first 100 days of investment, as we call, which is really the break or make time to set the board processes, the reporting processes in shape. Many a times we bring in external advisors to help us do that. And the accounting firms, Big Four, internal auditors do a good job at that as well. And then we have periodic check-ins, trying to get independent directors on board who have this experience of being on well-run companies. So these are the various tools that we bring into play. But I do think a large part of it is really entrepreneur alignment with the investor.
Great. Thank you. Thank you for that, Amol. And thank you for sharing your thoughts on all those topics so freely. You actually provided a very nice segue for me to carry on to Namita on education. In particular, I want to get into talent and talent shortage. But before that, Namita, welcome. And perhaps you'll give us some, Enzia is a relatively new fund. I'm sure you've had a very exciting year for more reasons than one. Perhaps you'd like to share some thoughts on how the year has been for you with respect to the education portfolio in particular.
No, thank you, Anuradha, for everything. It's been an exciting year. I think setting up Enzia and focusing on 3 sectors: education, healthcare, and climate. Just focusing on education, and Amol is a dear colleague from Omidyar Network, so we, it's like. So it's great to see him on the panel and the other people on the panel as much. So I've been working in the education investing space since 2017, and it's been, the last 2 decades has its own history in terms of education evolution. We've seen those ebb and flow. So I was not surprised when the IIC report mentioned that education did not particularly attract as much investment or was a little more sluggish. But just kind of introspecting on the last 3 years, right? So the pandemic definitely gave an acceleration, but in 2019 itself, we started seeing another wave of emergence of edtech and the adoption by consumers on the education front. That is primarily because of the geo revolution, when the online live classes became an important way that children were accessing learning. And of course, with schools shutting down or closing and colleges closing, online live learning became the medium to educate children and young adults. While there has been a lot of euphoria during pandemic, there is also there are 3 particular things that I have noted, especially from the impact investing angle. One, the focus on vernacular and the low-income population when it comes to edtech solution. There, it's not just about taking the existing solution and repackaging it and bringing it to the low-income population, because you cannot have your CACs high. The customer acquisition cost needs to be lower than what typically an edtech currently sees today, because the price points are lower. And we have to figure out we have to really innovate on the product side to make it vernacular, mobile first. In fact, to that extent, we invested in a company called Curious Junior, which is a tech-first company. So what Curious Junior does is it basically delivers the entire learning of coding experience, ability for children to build games, apps, learn coding just on mobile phones on the Android devices, which otherwise requires a child to have a laptop or a teacher on the other side, costing in the premier segment anything like 500 to 700 rupees per class. So the vernacular mobile first solution is an important one to really crack the impact at the lower income segment. The second one, Anuradha, you were talking about the talent shortage, and what I also noticed that while an IIC report also highlighted a lot about the test prep in the K-12 market, but I like to disagree and say that there's also been emergence on the employability side, while the last 10 years has been a lot about vocational training and more brick and mortar solutions. Now, we started from likes of Upgrad or Great Learning, doing upskilling for the tech workforce. But what we've seen a lot more happening is training of college students, training of students, what I like to call -2 to +2 years of graduation, and really making them employable. And the interesting trend is also linking them to outcomes. Some businesses make it very, very clearly linked to outcomes. That means you only pay fees when a trainer or a company is delivering outcomes to the students. So that, I think, is an important trend that we will see, and we should see more on the education side, because ultimately outcomes is what matters, and the businesses which deliver outcomes will, we argue, will become the sustainable, long-lasting businesses. And the third one, while a lot of edtech has happened in the B2C market space, given India, parents spend a lot of disposable income on education, not just in school, but also after school. But last year and a half, we've also seen schools adopting technology. That has happened because of the pandemic, as much as schools were not left with a choice to adopt technology. And teachers also started to get out of their fear or get out of their inhibition to start adopting technology. And that is really important because a child spends about 6 to 8 hours per day in school. And if the school-based learning does not change, we cannot start seeing the impact of technology in education. So the players like Lead Schools or YOLO are doing fantastic work in terms of getting learning edtech in the hands of teachers and the students in the schools. So would love to see more of these trends playing out. Would love to see we going beyond the tip of the iceberg, because while there has been a lot of funding and there's been a lot of unicorns and companies being built, there is a lot yet to be done. And even if it paces out and is slower in the coming years, I do think there is a lot of activity that needs to be still done, a lot of entrepreneurial innovations to be fueled over the next 10 years in order to continue to reap the benefits of technology for education.
Yeah. Thank you, Namita. So you actually, I was quite heartened to hear that you are sort of seeing a fair bit of deal flow on the skills side, because in my reading of IIC's report and what little I see from Baytree is we barely see skills and employability related deal flow, and much more on the K-12 and test prep. So just, and anybody on the panel, you're welcome to sort of jump in on this. I want to know, as a ratio, what is the ratio we see between K-12 and test prep versus skills and employability deal flow? Because it really feels to me that if you talk to anybody in the private sector in India today, everybody's talking about skill shortage. Amol, you said you have to make 3 offers to get one, and you're lucky if you would do that. It's been a similar experience for us in Baytree. But if you talk to somebody who's doing pure technology, even IT, coding, anything, it's the same issue. So it's not as though we have a dearth of engineering graduates in the country, right? But there is clearly a mismatch somewhere. Is anybody else sort of seeing sorry, Namita, first do you have a sense of the sort of ratio of deal flow between K-12 and test prep versus skills and employability?
Yeah, I can take a guess estimate here. And I think it's also a little bit of, flavor of the season or the theme of the season, right? So I think while we can look at what has happened over the last 2 years, in fact, a lot of companies I've seen in the K-12 side are not necessarily the academic K-12 side. We saw about 40, 50 companies just in the extracurricular space, right? Everyone trying to look at the space from a different way, but really trying to solve for how do we go beyond academics for children at early age.
It's partly driven by numbers, right? Because you can get your 2x, 3x, 4x much faster in those spaces.
Yeah, and I think a lot of new entrepreneurs also seeing the problem at their homes, right? Like the child is at home. There is an academic learning happening almost, which is broken experience, but also no social element or no social learning besides the academic, right? So I at least, especially on that side, thought that entrepreneurs were also kind of solving problems for what they're seeing at their homes. But and yeah, it is true in the K-12 side, there is a longer LTV, the lifetime value. So if you even if you are making a test prep business, you can go from grade 9 to grade 12, and sometimes even beyond grade 12, right? And I think the difference between a K-12 business and the skilling business is the LTV is very different, because in the skilling, it's only after a few years that the career aspirant may come back to take another course. So really the companies need to work on the contribution margin from day one. So it's a very different business. You have to show outcomes for those students or the youngest parents to meet their employability goal. But just coming back to your question, I'm not nowhere saying that the deal flow is great on the skills side, but I definitely see a lot more people paying attention to that and working in that area. And also, I think there's, always the role models of the companies making it in the subspaces becoming larger helps the ecosystem to, on both the investor side and the entrepreneur side, to do that. And that's why I quoted the examples of, Upgrad or a Great Learning, who've gone to become large businesses. In US, there are at least 4 unicorns in the same space, right? And so I do think that is where heart of our problems lie. And I would love for entrepreneurs to work in that space, and for investors to look at the edtech business and the skilling space differently, and see for what it is worth, and fuel the innovation there.
Thank you.
And just to build on what...
Yes, carry on, Shiva.
Sorry, Anuradha. Just wanted to build on what Namita was saying, that I think absolutely, Upgrad, Great Learning have been 2 brands that have established themselves at a larger scale there as well. But I think this year was an odd year where I think that upskilling tech space that Amol was talking about, we had probably Masai raised, but Scalar raised right after the year ended. So it's that's why it's probably not in this report. But you have a few of these tech-focused vertical skilling companies coming through as well in that outcome space that Namita was talking about. And we're also looking at other opportunities outside of the tech verticals and saying, can you build verticalized models in some of these spaces? And there had been other companies that have also built out, just some that come off the top of my head, models like BitClass that are trying to do an Indianized version of a Maven Reforge, which is saying, can we upskill individuals who are already working or interested in a career path? So we've seen, I think Growth School also raised earlier this year, which is, they're not directly tying themselves to outcomes for some of these models, but they're playing in that in a similar space to what Namita mentioned, which may not have raised a lot of capital before, but I do think a lot of investors are watching out for that space of saying, can this be the next area that actually booms in edtech?
Great. Thank you for that, Shiva. So Namita, my last question to you, as for everybody else, is gender. And it should come just to sort of see, how are you approaching, particularly as a women VC led fund? Is there any difference? How easy or tough are you finding to source deals with a gender lens?
No, that's a great question, Anuradha. And I have to admit it on this panel that, for us to embrace the gender lens, took us time, even though we are three women, who've come together to start their fund. And primarily because we actually were approaching it first from sectoral perspective. The 3 of us actually bring deep experience in our sectors where we are investing. And the main idea was never to invest in women founders, but really to fuel innovation and solve large problems in the sectors that we have chosen to work in. But what we have also seen that 4 out of 8 companies across our syndicate and the companies from our fund have women founders. And 3 out of those 4 companies are actually working on the women segment. So that is very, very encouraging to see. And when we reflected on this, for us, it was really about having an unconscious, having no bias towards gender, right? So really kind of being able to see actually, despite the gender, like what is the company doing, what is the founder like, and maybe that's what has helped us to kind of do what we done and hope to do more of it. We've also taken a look at the framework that Amol was talking about. It's the 2x challenge framework. And in fact, we have integrated, adapted and integrated it as part of our own impact framework, where we are committed to track the gender metrics across our businesses, which goes across women founders, or the women on board, or women segment being targeted, and women in across the value chain. So really committed to kind of track it and work on it through our deal sourcing as well, and learn from it, and then really reflect and see what is working, what's not working. In no way we have solved for this problem, and we are as much on the learning journey and figuring out what we can do our bit on the gender lens.
Thank you. Thank you so much for sharing that, Namita. And we'll circle back once we've gone through everybody else as well. So we'll move on to agriculture and to you, Shiva. It's been a milestone year in some ways, particularly with Dehat and the valuations and the fundraising sort of really given the sector a boost, even though sector interest has always been high in India. So welcome and would love to hear your thoughts on the year that has been.
Yeah, thanks, Anuradha. Agree with you overall. I think it was a great year to see agri-tech continuing to grow from probably a volume perspective that it has the last few years, but also see diversity in the models even at the late stage. So typically what we'd seen was you would normally get the high value investments only flowing into companies that were either in a B2C model or in the agri output chain. So we'd seen companies previously like Vicious, Waycool, Big Basket raising in the past and scaling their models. And we did continue to see Ninja Cart, Payhart raising large rounds of funding this year. But seeing AgroStar, which is an agri input company that was also amongst the largest set of fundraisers, also shows that there's a diversity to how different models are building out in the ecosystem. And I think that's a strong positive that we'll be carrying in across for the next few years as well. Just as I was looking at the themes overall that happened this year, broadly for me, it bucketed across three themes. One was seeing a new range of purely commercial investors entering the space as late stage investors. So we saw the Tiger Globals, we saw some pure play wealth managers in India like IIFL, etc., investing in agri-tech and very Indian model agri-tech startups. So this is not applying models and use cases from other regions, but really understanding the region and saying this is something that they believe deeply in. Investing, I think, across the late stages, having a diversity of models coming through. So I mentioned some of these with AgroStar raising as well, but seeing that a model like Animal, which is focused on cattle sales and how that can actually develop into a vertical of its own, or AgNext, which also raised for agri assessments. So seeing these other verticals really start to build up as probably not the same 50, 100 billion rounds that we talked of for the largest companies, but seeing these develop as other models coming through and growing in the industry is actually another positive. The third, I would say, is a continued behavior by the farmers and the agri corporates of saying we're willing to adapt to technology. I think when you look at the industry against how it was pre-COVID, there was still a fairly strong pushback saying I have an established way of working. I would prefer to keep my existing operation. This may be from a corporate perspective, a small pilot I do, but accepting that this is a way that they can embrace their business to actually drive efficiencies. And for farmers, the comfort that they've gotten with technologies and saying we're willing to try out new models that can help improve our business and our income overall has been a really strong positive. So I think those are three drivers that we did really get from this year. That being said, the capital flowing in of still being a little shy of 1 billion is still a drop compared to the fact that this is a market which is a 240 or $280 billion market just domestically. So there is enough series of opportunities, there's enough other avenues that we haven't touched in this segment at all. So there's still a large enough opportunity to really build on. And I hope the momentum of seeing more companies and a diverse range of companies getting to the late stage should hopefully open up a bit of this funnel of early stage companies also evolving and founders aggressively looking at this as an area that they want to build for.
Thank you. So Shiva, my question again, I mean, like with many other sectors in India, the bulk of the deals and the larger transaction sizes are happening with aggregators platforms, those kind marketplaces, right? And that's fantastic, and it helps drive capital. And it's important to demonstrate money flowing in and exits being made possible for investors. But beyond that, agriculture particularly is a sector where we can have a lot of science and innovation going in as well. So I'd like to hear from you, what sorts of deals are you seeing in that space, and what are the challenges to seeing more of those?
Yeah,
once the platforms are established, that sector is going to mature, input aggregators, platforms. Once that's done, what's next? Are we there with the next cohort of companies?
Absolutely. So I'll answer that slightly differently. I do agree with you that there's opportunities for science tech companies and deep tech companies to do things right, from how you can actually now reimagine seed research to be accelerated and get more products out. We've seen very interesting companies that are looking at how you can actually develop alternate proteins or alternate food products, as well as saying this is actually going to meet the consumer's requirements without requiring as much utilization of land or other resources to actually produce the food. So those are themes that we've definitely seen play out, and at least have a certain amount of pipeline building up there. So it's still small in absolute volumes. We see a lot more of other agri models that may be closer to the aggregators that you talked of, but maybe in verticals now rather than the generic ones that have already scaled. But these are models that are coming through the pipeline as well. We're hoping to look at some areas like that. But there's other opportunities as well. And I think if you look at just individual verticals of saying, if you look at something like sugarcane or just agri exports as well, those are markets as well that are 10 billion, 40 billion, depending on, I think exports would be up to 40 billion and sugarcane would be 10 billion. So these are large markets domestically to also say, here's how you can build Indian solutions in other areas. So it gives a lot of opportunities to say, here are the different types of models that actually can be built out in these pockets as well. And if there are deep tech innovations that are cutting across, we've seen them really build out for protein-based solutions and how you can actually reimagine food production in general. But we haven't seen too many on the entire research cycle of saying, how can you get into the seed research process and drive efficiencies there. I think that requires a different ecosystem to be built out. BIRAC has been doing a fairly good job from a government perspective of incubating a lot of these businesses early on. And it is a longer gestation than your pure commercial model. So it does take, even when you look at US proxies, it does take a certain amount of capital and time to be invested by some sort of grants ahead of time before commercial investors can come through. So I'm hoping those businesses will continue to mature and raise capital in the future, but will probably be a little more delayed than the marketplace models that we've already seen raising in agri.
Yeah. So you mentioned alt protein, and you look at that as a agri-based model. I imagine Akshay would look at it from a climate change perspective. So, are you sort of seeing collaborative ideas there where you're sort of ticking both boxes?
Yeah, absolutely. For us, I think a lot of our agri portfolio companies actually do check the climate box as well. Because if you look at just what we're doing from the aggregators we work with as well, they're very focused on saying, how can we minimize the food waste? And a lot of the challenges that are there across the Indian ecosystem from an agri production isn't that we don't produce enough food. It is the fact that we cannot get it through efficiently enough to a final consumer. So having companies that are able to address this are also addressing those challenges. And also from a climate perspective, being able to come in with advisory nowadays. And there's a range of companies doing that in different forms, saying here's how, because weather patterns have changed, because there is a lot more dynamic environment to what you need to plan out for. Both economic factors of how the supply chains are now working out, but also just weather patterns in general. Here's how advisory can actually guide you through to maximize your productivity. So the way we see it, a lot of the agri models actually cross the climate box as well and are able to create value in both ways.
Great. Thank you, Shiva. I'm conscious of time, so I'll pause here for now and move on to Srinivas. Srini, I'm going to use the opportunity of having you as CEO of Villgro to talk about two things. One, I'm sort of slightly springing upon you without warning, but hopefully not too difficult from your perspective. So we are going to cover healthcare. But I'd also like you to focus a little bit on this whole early stage theme that we've been talking about in this session, particularly as Villgro as an incubator. So we'll sort of just bear that at the back of your mind and bring it in as you can. But first, starting off with healthcare, what a year with COVID and everything, and what are your thoughts on this sector for the last year? And then I'll have some questions, of course.
Yeah, I hope I'm audible. It was an interesting read, the report, and I'm sort of sounding optimistic but pessimistic view on healthcare. The optimistic thing is that one of the biggest supporter in this country today of healthcare innovation is the government of India.
Yeah.
Yeah. The sad thing is I don't think any investor understands healthcare. I'm making a provocative statement. But that's because I think the way we're looking at healthcare in this country is, again, I think there was a lot of conversation about market linkages, pharmacies. That's fantastic. Yeah. So again, you're supplying medication. But the whole piece about screening, diagnostics, primary care, secondary care is completely, literally absent. Again, there are some interesting deals which happen in tertiary care. So I think one of the new ones is Pristin, which talks about safe surgeries. But again, overall, two things have happened. Number one, and big shift in the ecosystem is the move away from GPs towards specialization, which in many ways has increased the cost of healthcare in this country. Yeah. So what's happened is India is an interesting model where the private industry is getting a little more corporatized. The cost of healthcare has gone up, but yet innovation isn't supported, though the government of India is the biggest supporter. Yeah. And apart from the government of India, there is, I think, a fair amount of grants which go in, but that's about it. And when you come specifically into the areas in healthcare which are supported, most of it goes in non-communicable diseases, right? So one of the most recent transactions, I think that's a great example, is Zumutor, right, which is focusing on I think they've raised money from Sienna Capital, $6 million. So there is enough interest, more interest in NCDs versus some of the other areas, infectious diseases. We've gone through some horrifying times in COVID. Yeah. But not enough money still going there. Yeah. Because we spoke about COVID, for example, but malaria, chikungunya, dengue, Scrubs disease, and a whole host of others still infect large parts of India. Not enough innovation, hardly anyone working there. Right? Forget diagnostics, screening and all that doesn't exist. Then get into maternal and child health. Mental health is now getting interesting, right? Because if there is, I think there was earlier spike, some interest in folks like Practo on teleconsultation. And there was some interest in things like telediagnosis, right? And using AI, machine learning to start handling the challenge of the massive shortage in technical staff in this. But again, that sort of plateaued off. So what I think is truly needed is an appetite for innovation and the willingness. And I know the point will become, is that fitting into the horizon of a fund? Okay, inevitably it will not. So interesting point, for example, is Moderna, which is at the forefront of in this COVID fight, was founded in 2010 after Flipkart. Yeah, but it's interesting, it was supported and today it's in a place where it is. So how do we then integrate private, corporate, government, public health policies to create new models? I think there's a fair amount of innovation required, and that's frankly the need of the hour. Now there are some interesting innovation, attempts like the social stock exchange, a whole amount of interest in blended finance. A bunch of things are happening, but the question then always becomes: is anyone willing to look at a longer horizon for potentially a much higher payoffs? Yeah.
So that then sort of leads you very much into the public capital space, Srini, to be totally honest. And most health interventions, especially for communicable diseases globally, in the past have always been supported at best by blended finance rather than pure private capital. So in that sense, the scale of that challenge demands a response of an equivalent scale. And I would imagine that for most VC funds of the kind we see in the impact investing space, that becomes a bit outwith their mandate on the time horizons, if nothing else.
Exactly. No, so
On the
that's
risk
always going to be a
return.
question, right? It's always going to be a question. Then will healthcare ever be an interesting area apart from digital pharmacies,
Yeah.
teleconsultations, right? It'll always be a business first perspective, not a healthcare perspective first.
Well, having said that, we have seen some, solid models like Nirmai in India, right? Low cost breast cancer screening, which has gone on to become a successful enterprise. So it is possible. And, those kind of interventions can be funded.
Of course. So Nirama is a great example.
By the VC industry, because it falls within those kind of parameters. So what my question then to you, particularly as an incubator, is: are you seeing sufficient models of those sorts coming through your doorway for us to then pick them up and nurture them?
That's a fantastic question, because I think I'm at an early stage. My best pipeline is in healthcare.
Yeah.
Right. So if you see from true innovation, potential wave disruption in the space, I'm not talking only infectious diseases, talk across, right? So even the non-communicable diseases, or even in neonatology, in gynecology, some of the best in diagnostics, and so this is a fantastic pipeline. Yeah. However, it is after that it becomes a challenge. I'm seeing, for example, in agriculture, I see just way too much of the same.
Yeah.
We absolutely one clone after the other. Yeah. But it's here there is true diversity that I'm quite interested in. And now, for example, we are at Villgro been actively building models where we can integrate it into public health. We're seeing how we can integrate to the corporate world. We've seen some more interest. In fact, one of the exits Villgro had was one of our startups was sold to one of the largest IV fertilizer companies in the world, Perkin-Elmer. And they bought a 51% stake and they scaled it. But we see more interest from larger corporates.
Yeah.
Right. So it's possible that this sector does not have a cookie cutter VC only model. It's likely there are some other blended finance, innovative solutions in seeing how the investment horizon can be managed, and there's some risk appetite is being taken by some other fund flows. But yeah, I think pipeline is not a problem.
Pipeline is not. It's interesting you say that, because where I'm sat at Baytree as a marketplace, which is sort of open to all sectors and all stages of business, we see very little in healthcare. And I'd be curious to hear from other members on this panel if, I know you may or may not be sort of seeking healthcare, but you do, Namita, of course, you seek healthcare. Are you seeing pipeline as an issue? And what sort of pipeline are you seeing? Similar to the kind which Srini mentioned, or more sort of the,
No, I would say the pipeline is not an issue in early stage for sure. We also see, we probably would have seen about 400, 500 companies in healthcare by now. And in fact, the models that we have invested on are also maybe music to Srini's ears are, one of the diagnostics company building tissue scanner for digital pathology, and also not just building it for India, but already doing sales in Southeast Asia and US for that matter, or companies like Proactive for Her or iMoms, where they're taking an approach at women's health, full stack solution. So building digital health clinic with some offline presence as well. And the latest company we invested in is called Zenonco, which is really helping with the palliative care, actually the comprehensive care on the cancer side. So really going deeper into oncology. And of course, pharma is one revenue pool there, but it's not just pharma, it's really about the palliative care, giving services on anti-cancer diet, alternative therapies, and all of that. So I do think there's a lot of innovation happening now in the last 2-3 years on different aspects of healthcare and not just the digital pharmacy. But yes, a combination of capital may help. I have to say, just on the diagnostic piece, a lot more patient capital, maybe technology support will help before it gets to commercialization to the VCs. And players like CCAMP under Baytree are excellent incubators helping on that side. So government is doing its own bit, but I think that there could be more accelerators, incubators to specifically also go deeper into healthcare, because it does require a different approach to technology than other sectors.
So just building on what Namita said, for example, 2 of our startups, I mean, they've raised, and interestingly, we've had angel networks come in with reasonably large size funding rounds for early stage companies. Both, we've consciously asked them to move out of India and look at the US market. Because we sense all the solutions that we have here equally work in other parts of the world and have dramatic shifts in cost of treatment. Yeah. And we seem to see, we see that there's more traction there. There's more interest. There's a lot more willingness to check it out. And it's not as if, it's a little bit of a self-goal, I think, that India scored in way back in around December 2019, Jan 2020, when the CDSCO started looking at all devices as drugs. So we just made the pathway to commercializing that much more harder, right? So, I mean, it happened because of an unfortunate incident with hip implants for a large company, but then prompted the government to increase regulation.
Right.
So if you want to sell in India, it's just that much more harder now in the last 2 years.
Right. Srini, I have a question here for you, which is sort of refers to your previous comment from Ramraj, which says, how do we bring in large corporates, particularly with more connections into the health sector, and get them involved more centrally in this area?
So I'm going to borrow on our experience, what Villgro we've been doing. So we work with folks like GE Healthcare, right? And folks like Trivitron, Perkin Elmer. We work with other dedicated non-profits like the IHF, India Health Fund, which is funded by Tata Trust, right? And because there's a lot more focus they have in commercializing and with hospital networks. Yeah. So those are some examples to see how we play a role in integrating it into the health network. Yeah. So recently, I mean, it's not completely out in the open yet, but we're going to be starting this very large program with a multilateral organization in India. But across, we realize that capital is not going to come. It's faster and better if we can help these early stage healthcare startups integrate into the business, into the healthcare system. Number one. Number two, we are also trying to see whether we can do some kind of blended finance, even debt solutions. So because we run a small little pilot of a guarantee loan to support in working capital. So the moment a startup can get into market, we help in short-term debt. I mean, we work with partners with Caspian on that. And anything to do with bill discounting, account receivable, payable. So it's a little more like an SME approach, because there doesn't seem to be the risk capital coming in from VCs. But whatever it takes for the healthcare company to get into market and sell, that works.
Well, so that you can address on certain kinds of things, but the core need for risk-bearing patient capital hasn't gone away. You can't substitute that with bill discounting. So
yes.
Just sort of thinking, any collectively for the panel, any thoughts? And this is also Ramraj's question. He says, large part of health solutions could be hardware and product based with heavier investment cycles and manufacturing oriented. How can we create a base for more patient investors who can support manufacturing these types of innovations? I mean, the risk return matrix becomes very tricky, not least because of the investment cycle in an innovation cycle involved in these things. So anybody have any experiences?
I can jump at that too. Because we want to work closer with IIC on that, right? And I'm sort of preempting what we're going to be trying to do with Ramraj. I think these pieces exist. So there's a hospital chain, there could be a public health system. It is in connecting the dots between these pieces, making sure this flow can happen. Maybe in the flow, there's a little bit of capital required. There's a little bit of even technical assistance, if you will, and a corralling of different kinds of supporters, even if it could mean folks like a USAID in one end to an NHA at the other end. But someone literally who can orchestrate this chain, and that's what we're trying. And I think that's what I want to work closer with IIC on to make happen in this sector.
Great. And IIC is, I think this is a question more generally for the panel, but maybe more specifically to you as well, Srini, is they would love to know more about what kind of support you're seeing from the Indian government for the impact investing sector and healthcare more specifically. So, anybody can jump in, but Srini, more on healthcare from you.
So specifically, I think the government and under BIRAC and the DST, I mean, not just BIRAC, but also under DST, they have a whole bunch of different schemes, right from an idea stage to a place where an inventor can partner with a corporate. Yeah. So there's even an opportunity if I'm an individual PhD fellow, I have a corporate partner, then you could become, get funding from the government of India to scale that idea up. Yeah, to a stage where you have a product innovation or a hardware innovation. The government of India has grants. And this next step is they have matching loans, extremely low cost loans, right? Almost at repo rate, I think, where they say that we will match whatever up to a couple of, I think, $500,000 if they can bring in more money. So the government has been able to do both low cost debt and grant and look at right from idea stage till almost till commercializing. And so there's a whole bunch of people who go to the government who ask for it, and the government has been fairly generous. I mean, I really have to say that the amount of support, capital, the number of deals that the government of India has been currently working on is phenomenal. But it's after that, when you have to get into market, you have to get into distribution chains. That's where the fun starts.
Yeah, if I may, from Anuradha, from the IIC side, maybe I just want to take that question in some part. Yeah. So essentially, see, I think one of the challenges at a larger level is that impact investing or an impact enterprise today, there is no specific definition or anything like that. So one of the challenges is whenever we are trying to talk to the government, especially for a policy intervention, is really to be able to provide them with a framework, which is either legal or regulatory or otherwise in terms of, how do you really define or how do you really put together a structure to support, say, impact enterprises? Akshay can talk more about the SRI or the Self-Reliant India Fund, which is a fund which is now being run by, SBICAP Ventures, which really focuses exclusively, or not exclusively, but substantially on SMEs, particularly in sectors like all of the impact sectors, health, education, all of, sort of agriculture and so on and so forth. What we would really need, amongst many other things, is to provide a sharper identity for impact enterprise or a social enterprise or whatever else it is, so that it becomes more convenient and amenable for us to even talk to a SIDBI or talk to a NABARD or talk to somebody else, to be able to create a dedicated framework, either allocations for impact funds or incentives for impact related funds or for impact AIFs or any of that. Right now, that doesn't exist. The present social stock exchange, at least the draft regulations for the first time, have tried to define an impact enterprise or a social enterprise. It's a fairly extensive definition, which at least is a first step. But I think for us to really be able to leverage substantially from the government, and I think government by and large has been favorable. Our conversations have always been favorable. But I think what is really lacking is, because if I just say health, a tertiary hospital in the middle of Bombay is also health, and primary healthcare, which is operating in, say, a tier 5 or a tier 6 or a tier 7 city, also technically is health. So when you want to really get the government to allocate funds to something more targeted and specific, what is important is at least trying to get some kind of a broader, sharper identity available, so that enables various parts of the government who may be sympathetic to the cause to really do something more specific. That is an area that IIC has been trying to work in. The social stock exchange and some of the technical guidelines that they have issued is a good step, but there's a long way to go. Let me stop.
Great. I think we are actually not many more questions left in the chat box. So unless anybody on the panel has anything specific, please raise your hand. Otherwise, I think it might be time for us to wrap up. Okay, great. Well, thank you all so much. It was a fascinating discussion, very insightful for me, certainly. I hope you all enjoyed it too. Thank you for sparing us the time and for joining us today. Thank you to IIC for facilitating it.